Hi there, welcome to Kneppy Invest. Continuing on the theme, looking at financial year 22 results, in today's video, I'm going to be looking at a company called Data3. And to be honest with you, I've never had a really close, in-depth look at this company in the past. Every single time Data3 has popped up, I've had a cursory glance at what this company does and their financial state. And there's a few things that have turned me off this company, including what this company does. They are an IT services and solutions provider. And to be honest with you, I am not enamored with IT services companies simply because they are reliant on labor. So IT talent and labor, IT talent are expensive. And when I do have a look at quite a few of these companies, one of the first things they do report is the increase in employment, increase in staff they have on their books. So that is one of the main reasons I'm not that enamored by these sort of companies, because labor costs a lot. And when you look at the margins for a lot of these companies, they have really tiny, small margins. We're talking about gross margins of maybe less than 10%, profit margins less than 1%. And you'll be able to see that with Data3 financial year 22 numbers. In fact, this company has over $2 billion of revenue. So you might be thinking, $2 billion of revenue, this company must be bringing in a cash load of money. And that's not true. You'll be able to see that when I show you the financial year 22 results. Now, in saying that, this company has been increasing their revenue through time. Over the last 10 years, every single year, this company has increased their revenue, has increased their profit. So I think it's a good idea to take a closer look at this company to see whether it might be a nice little good quality buy right now. So that's what I'm going to do in this video. Have a look at the quality of this company and also have a look at the valuation, because those are fairly important, and also determine whether this company could be considered high quality or low quality. That's also a very important determinant when you're looking at or researching company for the very first time. Now, this company does a lot. So they consider themselves to be an IT services and solutions provider. And I'm just got their website open, and I'm just looking at all the services and solutions they provide. And there's a lot. Consulting. And in the consulting area, we're talking about digital and ICT advisory, transformation and governance, cybersecurity and risk, information analytics. In the procurement, we're talking about contract management as a service, hardware procurement, licensing services, equipment staging, financing and leasing. We're not even going to talk about what they do in the project services part, managed services part, and resourcing. And then in the solutions division, they have cloud, modern data center, public cloud, Azure solutions, modern workplace, collaboration, end user services, security, cloud security, data security and privacy, identity and access management. Now, this is one area that could be interesting, because this is definitely going to be a growth area over the next 5 to 10 years, particularly with all the breaches or data breaches we have seen in Australia in recent years, including Optus and the company or organization I work for. Now, also Data3, also in their solutions area, provide data and analytics, so business analytics, customer management, IoT, location-based analytics, technology, intelligence solutions, etc., etc. So this company is providing a lot of services and solutions, and that's probably why the revenue of this company is $2.2 billion. Now, before we talk about the next thing we're going to talk about in regards to Data3 is whether I consider this company high quality or low quality. In fact, that's the first step, and maybe the most important step I take when I first start researching a company. But before we talk about that, what are the next 5 companies I'll be doing in this series? And there are a few companies here I have never had a look at before, including NextDC and High Tech Group. Not even sure what High Tech Group does. They might be in tech employment or something like that. The other 3 companies I'll be looking at, BlueScope Steel, that will be my next video, and also IPD Group and PWR Advanced Cooling Technologies. Now, for full disclosure purposes, the only company I actually do own here is IPD Group, which is a newly listed company on the ASX, but the company has released 2 profit upgrades since they've listed on the ASX, and their chart looks absolutely fabulous right now. The other company, PWR, is a company I don't own, but would love to own. My only problem with PWR is the valuation right now. And if I see a significant pullback in the share price, I would probably be taking a position in that company. So if you have any ideas of companies you'd like me to do in a future video, leave in the comment section of this video. Preferably, any suggestions should be profitable companies and also growing companies in terms of revenue. So leave any company you'd like me to focus on in the comment section of this video. Now to the quality of data 3, and this is usually the first step I take when I first start researching a company, because how I treat a company is dependent on whether I think it's high quality or low quality. So for high quality companies, and if I thought data 3 was a high quality company, it would be all about the valuation. What is the valuation of the company right now compared to historical levels? Do I think it's expensive or cheap? If I think it's really, really cheap, I might be thinking of taking a position without even looking at the chart, because I don't really care about the trend in the share price or sentiment. If it's a high quality company, it's all about the value. But if I consider data 3 to be a low quality company, it's all about the share price trend and underlying sentiment, and the value of the company is much less important, because I just want to do maybe I'd say a quick trade, but we'll say a short to medium term trade in the company, but it's definitely not a long term hold if data 3 is a low quality company. So what do I think in regards to data 3? Is it high or low quality? And to be honest with you, I am completely undecided. I have arguments suggesting this company is high quality and other arguments suggesting it is low quality. Now, some of the high quality arguments include revenue growth. This company consistently grows their revenue through time. This company is also profitable, and I think that profitability and that growth in revenue will be able to continue for the long term. Also, the industry they're in, particularly the cloud security or data security, I think is a growth area. So there is that potential for continuing growth in the future. Now, on the low quality argument side, the margins. Now, companies within this industry or this sector have typically really low margins. And even though there are some high quality companies out there that have really low margins, I'm looking at Costco as one unique example, I would prefer a company to have higher margins. The other negative thing about data 3 is they have falling margins. So I did have a look at gross margins, profit margins, and their gross margins have been dropping over the past 5 to maybe 10 years. In fact, gross margins right now are at 10%, which does seem really, really low. And one of the ways to determine if a company has competitive advantage or a moat is having a look at their gross margins. And if gross margins are dropping, that is a sign a company does not have a competitive advantage. I have seen companies grow their gross margins over time. And that's actually a good sign that a company is developing a competitive advantage. And a really good example of a company developing competitive advantage is around branding. So a company, when they're born, doesn't have a brand. No one knows their name. And they have to build that brand over time. You think of Apple. Back in 1960, no one knew Apple existed because it didn't exist. And Apple had to build their brand over time. Same thing with Coca-Cola. And I think what's happening right now with a company called Breville, they are developing a brand, or their brand, worldwide. And it wouldn't surprise me if Breville increases their gross margins over the next 5 to 10 years just because of their building brand part of their life cycle. So at this point in time, I'd say that data 3 is somewhere towards being in between high and low quality. And I think this is all about individual opinions. So there's no definitive answer when it comes to the determination whether a company is high quality or low quality. And I haven't got to the point where I can really pinpoint that data 3 is a high or low quality company. So I'm going to leave that argument to you. And during this video, I'm going to look at the value of the company and also the charts, and to see whether we could actually take a position in data 3 based off value or based off the share price movement right now. Funnily enough, one way you could determine the quality of a company is just by looking at a longer-term chart. And this is data 3's weekly chart over the past 10 years. In fact, a little bit longer than 10 years, from the end of 2011. Now, if you look at the period between 2011 and the end of 2018, share price of data 3 almost was going sideways. There was not much movement in the share price. So that was not, or is not, a good sign that Data3 is a high quality company. But then during 2019 into the middle of 2020, the share price of this company increased by fivefold from about $1.40 to a high of $7.20. And then from the middle of 2020 to now, the share price of this company has just gone sideways. So there's only an 18-month period over the past 10 years where the share price of this company did anything. The rest of the time, the share price of Data3 has just gone sideways. So if you look for the start of this period to the end of this period, the share price has increased over the last 10 years. So you might say, well, this is a high quality company because the share price has increased over time. But the majority of the heavy lifting in the share price of this company was done in an 18-month period. And for high quality companies, I'd like to see the share price climb gradually through time, not in just an 18-month period like Data3 has done. So even just looking at the long-term chart, you could have an argument that this is a high quality company, or you could also have an argument this is a low quality company. So no answers here just by looking at the long-term chart. Now on to the financial year 22 results for Data3. And before we have a look at the revenue, profit, and operating cash flow, what is the market cap or the valuation of this company right now? At a share price of $6.36, Data3 is almost a $1 billion company. And that's on revenue of $2.2 billion and profit of only $30.3 million. So I've already talked about margins. And just by comparing the revenue here to the profit, you can see this company has really, really low margins. So we're talking about 1.5% profit margins. And that is a little bit of a concerning thing for me. But there are some high quality companies out there with really low profit margins. I'm thinking about Costco. You could also argue that supermarkets are high quality companies like Woolworths, Coles, and they have really low profit margins as well. So that's one little negative thing I have about Data3 is just their margins. Now, the really interesting thing about their operating cash flow, it was negative this year. And when you include leases, they had an operating cash flow outflow of $25.3 million. And I'll show you the cash flow statement in a few slides. Not only was this year operating cash flow negative, last year was operating cash flow negative, and that really piqued my interest, not in the fact that this company is a great company, good quality company, is just it piqued my interest in why this company was operating cash flow negative in 2 successive years. Does this pinpoint a problem around this company? So I'm going to explore why this company was operating cash flow negative in this particular year and also in financial year 21. And the earnings per share for Data3 was 19.6 cents. So we can actually look at the P ratio quickly just by comparing the markup to the profit. So this company has a P ratio greater than 30. So straight away, when I saw that, I was questioning whether this company is a little bit overvalued right now, why the market was putting a little bit of a premium to Data3 with these results, and the very fact that I think there would be a lot of questioning whether Data3 is a high quality or low quality company out there, simply because I'm undecided right now where Data3 fits in the quality spectrum. One of the best predictors of future outperformance of a company's share price is revenue growth. Research has been done on this, and this is one of the greatest predictors or the best predictors for future total shareholder returns. And we're talking about the top quarter percentile of companies on the equity markets. So this is one of the reasons why I look at revenue growth and why I wouldn't say obsessed with revenue growth, but I definitely want to see a company growing their revenue over time. And this is probably the preeminent argument on why Data3 might be a high quality company, because this company has increased their revenue at a consistent rate year on year over the past 10 years. In fact, they've increased their revenue from $809 million in 2012 to $2.2 billion in 2022. Not only that, when you calculate the compound annual growth rate in revenue, and this is revenue per share, over the past 10 years, it's 11.3%. But that rate of growth has increased over the past 5 years. So now it's up to 15.6% per year over the past 5 years, and hasn't slowed down, because over the last 3 years, it's still growing at 15.5%. So it does look like potentially revenue growth is accelerating. So maybe Data 3 is building a little bit of a brand out there. And maybe that's why they're increasing their revenue. However, in saying that, gross margins have fallen. And I would like to see gross margins starting to rise. Gross margins right on 10%, not only financial year 22, but also financial year 21. So at least gross margins didn't fall in this financial year from the previous year. Now on to the cash flow statement, and this is quite important financial statement when you want to try to understand why Data 3 was operating cash flow negative. And to be honest with you, you get no answers in this particular statement. You actually have to have a look at note 6, which is the reconciliation of the profit to operating cash flow. We'll have a look at that in the next slide. But this confirms that Data 3 was operating cash flow negative by $22.6 million in financial year 22, and was also operating cash flow negative by $22.7 million in 2021. So this really interests me. This really perked up my ears. I was like, saw those two numbers, and I went, whoa, wait there. If this company is operating cash flow negative and also paying out dividends, so $25.9 million of dividends in 22, $22 million in 21, this company is burning through a lot of cash. And in fact, the cash on hand for Data 3 has fallen from $255 million to $149.5 million in 2 years. So that is a little bit of a concern for me when I first saw the statement of cash flows and saw this company was operating cash flow negative and now burning through a lot of cash. But we do get some pretty good answers to why this company has been operating cash flow negative over the past 2 years when we go to note 6, I think it was 6, which is the reconciliation of net profit to net cash flow from operations. And the reason I love the reconciliation of net profit to cash flow is because you can understand why there's a discrepancy between the profit and the operating cash flow. And for Data 3, that discrepancy is a profit of $30.3 million and an operating cash flow negative state of $22.6 million. So how do we get from being a company from being profitable to operating cash flow negative? The first thing you always have to have a look at is depreciation amortization. For a lot of companies, particularly those who spend a lot of money on capital expenditure, that depreciation amortization can be fairly high. And that could explain the discrepancy between profit and operating cash flow. For Data 3, that is not the reason why, because depreciation amortization in 22 was only 6.2 million, in 21 was 6.1 million. So that's not the reason why. So we have to dig a little bit deeper and go to the working capital changes. And more than likely, in most scenarios for companies where there is a large difference between profit and operating cash flow, it's going to be around working capital changes. And working capital changes revolve around changes in receivables, inventories, and payables. And there is definitely a significant increase in receivables and inventories for Data 3. $132 million increase in receivables and inventories in financial year 22, and $150 million increase in receivables and inventories in 2021. But there's also an increase in payables, $61 million in 22 and $95 million in 21. So if you get an increase in receivables and an increase in payables, they do cancel each other out. So if you calculate the total change in working capital, we get a number of around about 132, $71 million in financial year 22. So that's one of the reasons why this company was operating cash flow negative. If you add back that $71 million to the operating cash flow negative state, you get a company that was operating cash flow positive by about $50 million. And that makes a little bit more sense. And that's also true for financial year 21. And then in the presentation, and I think it's very important to have a look at the presentation because the company might explain a little bit further on some of these details. They did mention that the underlying free cash flow is typically between $15 million and $20 million, but has been reduced in financial year 22 due to inflated inventory positions at year end. This is expected to normalize in the first half of financial year 23 as a backlog unwinds. I slightly disagree with that because it's mostly because of an increase in receivables, but there has been a significant increase in inventories as well, and that will unwind. So I do expect this company to be operating cash flow positive in financial year 23 by a big amount. So we're talking about maybe 30 to 40, even $50 million. So just because your company was operating cash flow negative in the last 2 years is not a negative thing for this company. Now to the valuation metrics for Data 3. And if I thought Data 3 was a high quality company, these numbers would be really, really important because Data 3 has a P ratio right now of 31.9. Is that high? Is that low? Or is that normal for this company? That's a really important question if you think this company is a high quality company. If it's really low, this company could be a screaming buy. So one of the things I like to do when I'm looking really first researching a company and I see a PE ratio, I want to know how that PE ratio of the company right now compares to the previous PE ratios of a company over the past 10 years. So I'm going to show you the historical PE ratios of Data 3 in the next slide. Now, on first impression, I would probably say that a PE ratio of 31.9 for Data 3 is a little bit too high. So the market is paying a little bit of a premium, in my opinion, for Data 3 right now. Price to sales ratio, now I'm not the biggest fan of price to sales ratio, but it does give you an idea about the quality of revenue. We already know the quality of revenue for Data 3 is quite low because of the low margins, and we also get a sense that with the price to sales ratio of 0.44. And of course, this company doesn't have any operating cash flow, so there is no price to operating cash flow at this point in time. Although if you did calculate, it would be negative because operating cash flow is negative. Now, the last thing I like to do for all companies is do a reverse DCF. I don't like doing normal DCFs simply because of the variables you might be putting in there. You could change the variables and get completely different outcomes. I like doing reverse DCFs because it gives you an idea about the growth a company needs to show us the market to justify the current valuation. So with the reverse DCF, and because this company is operating cash flow negative and free cash flow negative, I needed to use earnings per share. So really it's a reverse, so DCF means discounted cash flow. So it's really a discounted earnings per share. But to justify the current valuation, Data 3 has to grow their earnings per share at 18.9% per year over the next 10 years. So that does not necessarily mean this company is expensive right now. I could consider a future where Data 3 absolutely does that. But I would prefer that reverse DCF percentage number to be a lot lower than it is now, just for a margin of safety. Now to the historical PE ratio numbers for this company, Data 3, over the past 10 years. And this is really important because we can determine the current valuation, whether a company might be expensive or cheap, just by comparing the current PE ratio to what we might expect over the past 10 years. Actually, not what we might expect, what we did see for the company over the past 10 years. And this company did go through a growth phase. And when I say growth phase, I'm talking about multiple expansion in 2019 into 2020. So what do I mean by multiple expansion? Well, the P ratio increase. So remember during that period, the share price increased fivefold. So did the profits of this company increase fivefold during that period? Definitely no. So what caused the share price to increase by 5 times? It was because there was multiple expansion. So the market was willing to pay more of a premium for the company for some reason, and the P ratio increased from 12.5 at the start of 2019 to a high of 47.5 midway through or towards the end of 2020. So again, a significant amount of multiple expansion caused the share price of this company to expand during that period. So that was absolutely crazy, because if you go previous or prior to 2019, the P ratio for Data 3 hovered between about 10.5 and 22.5. And that 22.5 was for a brief period. So if you bought this company at a P ratio of 22.5 prior to 2019, that would have meant you've been buying this company at a premium and it would have been an expensive buy. But if you bought Data 3 at a P ratio of, say, just above 10, you'd be buying this company quite cheaply. So right now, P ratio of this company is around about 31, 32. And if you look at the whole period, the 10-year period here, you are buying Data 3 for a premium right now at that P ratio, but a little bit of a discount to what you were paying for at the height of the share price back in the middle or the end of 2020. The last thing I like to do when a company releases the financial year results is just to have a look at their outlook and any sort of guidance the company gives. And the main thing I'm looking for here is any numbers. That's the first thing I will always look for. Is the company giving us numbers? So numbers in regards to revenue, EBITDA, or anything would be good. But the majority of companies I've noticed in financial year 22 have not given us numbers. So the next thing I look for is the sentiment in the words they're using. Are the management a little bit positive about the future, or are they negative? And when I did have a look at Data3's outlook, they were positive. So for instance, the backlog from financial year 22 has again provided a fast start to the current year, and we are well positioned to capitalize on opportunities this provides. Services growth will continue to complement software and infrastructure divisions while improving recurring revenue and margins. So I like that, improving recurring revenue and margins. Growth in cloud business provides data and insights to enhance life cycle services. That means nothing to me. Supply constraints set to continue in financial year 23, well placed to grow market share by leveraging market leading relationships, strong pipeline of major integration project opportunities as large corporates and government drive transformation agendas. So no numbers provided here, but there is some positive sentiment in this outlook given by Data3. Now, because I am undecided about the quality of this company, and if this company I thought was a high quality company, it would be the valuation I'd be focusing on. I'd be honing on the valuation. And to be honest with you, PE ratio of 31 probably would be suggesting that right now I don't see any value in Data3. If I saw the PE ratio of this company like 12.5, I would be much more interested in this company. So, because I don't see any value, what about the charts? What about the share price? What is it doing right now? And this is the daily chart of Data3 going back to the end of 2020. And when you look at the daily chart, share price is just going sideways. We already knew that when we looked at the daily or the weekly chart at the start of this video. The other thing or main thing here is that the share price of Data3 has been trading in a range over the past 2 years. When the share price gets up towards about $6.50, that's the time to sell. We have seen that about 4 times in the past, and the share price is hovering around $6.40 right now. So it's getting towards a point where you might be thinking about selling out your shares of this company because it's getting to the top of that range. But if the share price of Data3 gets, say, below about $4.60, that's the time to take a position in this company. So maybe this is a trading stock right now. And when I say trading stock, I'm talking about the short term because share price of this company is going sideways, but it is trading in a range. And right now, if I had my say, if I was a trader, I'd be looking at maybe getting out if I was holding any shares in this company. But I'd be waiting for a breakout in the share price above about $6.70. If the share price gets above $6.70, that would be telling us the share price is breaking out of this trading range, and that would be a bullish move. That's all I have for this video, looking at Data3's financial year 22 results. I'm still undecided on whether this company is high quality or low quality. What do you think? Is Data3 high or low quality? So just give us your thoughts in the comment section of this video. 1 minute I'm thinking one way, the next minute I'm thinking the other way. I look at the revenue growth and the future potential for revenue growth. I think this could be a high quality company, but then I just think about the margins, and that really is a turn off, those really low margins, and also just the sector this company is in. I just don't like the sector at all because of the reasons I gave you earlier in this video. Anyway, if you have any thoughts, any concerns, any questions, leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.